Good day guys, in this video we are going to talk about monthly paying investments listed in ASX. I found 12 of them. These are some of them: Matrix, BetaShares, HVST, Dividend Harvester, Perpetual Credit Income, Plateau 8, eInvest, EIGA, and MBI, QRI. So if you see any of these names that you are interested in, make sure you watch till the end because you will learn the catch of investing in a monthly dividend paying investment. This video is a reply to our friend Sumit. So here are the comparison criteria. First, the average distribution yield. Second, the unit price growth. Will these fund managers preserve your capital or will they do a disservice? And third, we're going to compare the total expense or the management fee for all of this investment product. So let's start with the average distribution yields. So how I do this is that, say we purchase BetaShares Dividend Harvester 7 years ago, and I use that buy-in price to calculate the yields, and here are the results. Number one, we have BetaShares Dividend Harvester. They give average distribution yields of 8% per year. That is amazing. Followed by EIGA eInvest with 6.9%, and MOT, Matrix Income Opportunities, that is investing in private credit, of 6.5%, followed by Plateau Income, PL8 LIC with 5.9%. We have the poor performers such as KKC, KKR Credit Income, that is investing in debt and bonds, and also BetaShares High Interest Cash. But here is the twist. If you look at the unit price for BetaShares Dividend Harvester, the unit price for the past 7 years is actually really bad. It's negative 7.6%. Wait, what? I'm not joking. If you look at the unit price chart since November 2014, it was traded at $25.32, and over a 7-year period, it has gone down to $13.77. So invest in BetaShares HVST 7 years ago, you would lose negative 45% of your capital. And there is definitely an investment strategy issue. So on the unit price growth, I highlighted anything below 2% red because you gotta think about inflation as well. From what I know, for the past 30 years, since 1990, on a 30-year average, Australian inflation is about 2.5%. So you gotta think again as well, is that you want a high return, but also you're gonna bear more risk. The one that gives you high return are the ETF and LIC or funds that is investing in stocks, and stocks will give you volatility. So it has been a good years during this study, about 3 to 4 years since inception, but there could be a bad time as well. For example, if there's another COVID happen or another debt or some financial crisis like the GFC. So in this slide, I add up the unit price growth plus the average distribution yields, and then we rank them from the largest to the smallest. So the first criteria winner, BetaShares Dividend Harvester with 8% average distribution yield. However, it has a negative 7.6% unit price growth. If we add those two on average, the real return is about 0.4%. And we have the top 3 winners, such as MOT, Matrix Income Opportunities, with a total return of 10%. And that is really high because, again, private credit is riskier because you're pretty much lending to private companies that we don't know if they can pay back or not, how good is their credit history, and so on. And we have this 5 product that is quite average, such as EIGA and BetaShares CRED, MXT from Matrix Master Income, that is investing in corporate bonds. We also have BetaShares that is investing in hybrid securities with a ticker code HBRD, has the average total return of 4.5%. This table clearly shows that high risk investment will give you higher return. Private credit, ASX stocks. Lower risk investment such as cash or bonds will give you very low conservative return. Next, we're going to have a look at the total expense. And here is the catch of monthly paying investments. Because these fund managers regardless of what structure they employs, the underlying asset only pays to the fund managers quarterly, 4 times a year, or twice a year, not monthly, and then they receive the money and they redistribute to you. They have to make sure they have enough reserve to pay to the investor. They need to also bring return to the fund itself, otherwise it'll be a negative return story like the BetterShares dividend harvester. So it is a very difficult task to do. Not many fund managers can do this difficult task, and yet they're charging very, very expensive fees. For example, MOT, Matrix Income Opportunities, has a total expense to the net asset of the fund of 1.4%. Surprise, surprise, the poorest performer, KKC or KKR Credit Income, has a total expense of 2.1%. I would like to finish with this, is that most of this fund, if you look at the inception date, they've been around for about 5 to 3 years, so they are fairly new. We have seen a stock market crash due to COVID panic. If there is another GFC that happens in 2008, I don't think this fund will do very well because of the investment strategy that they have to pay monthly dividends, because their underlying investment can be wiped out in value by another type of GFC crisis. Thank you.